It's back to school time here in August 2023, and we're going to go back to basics on the market, so stay tuned. Hi, I'm Theresa Wellman with Homeowner Experience Real Estate, and today we're getting into the closed data for July 2023, and we're going to talk about some market basics and what dictates the flow of how fast, how much prices are selling for, and talk about the forecast moving forward. So let's go ahead and jump onto the screen and let's talk about the four main pillars of the real estate market. We've got demand, which we talk about every month, supply or inventory, which we also talk about every month, affordability, which we talk about components of that, as well as availability of credit and how easy it is to go out and leverage to get into a property. All these factors are really critical basic pillars of the real estate market. So as our kids go back to school, let's talk about these fundamentals a little bit more to understand the overall real estate market, because we are in quite a unique time right now. So in regards to demand, unemployment levels, which we talk about every month, are really critical because if people don't have a job, they're obviously not going to have demand to go ahead and buy and afford a property, and that might affect inventory, right? But it definitely affects demand. Also, demand is how many people are out there shopping. There's several different factors to that. People just naturally age into home ownership, but there's also household formations and what we would normally expect nationwide and what actually is happening. And you may have heard different demographics with millennials are aging into home ownership, and that's a large generation, so that could push our demand. You've also heard maybe baby boomers might be selling, and that could push up our inventory. So there's some of those demographics, and that is something that is tracked nationwide. And the interesting thing is with COVID and with a millennial generation aging into home ownership, even though they expected about 1.3 to 1.4 million households to be created or additional buyers to come into the market over the last several years, we actually had almost 1.8. So more people pushing into the market with that demand. And we saw that going into the pandemic and through those years of the pandemic for sure. Then supply. Supply is actual homes on the market that are, recurring inventory used existing homes. That's got an interesting effect right now with the lock-in effect. And what I mean by that is a lot of existing homeowners have locked in an extremely low interest rate between 2.5% to 3.5%. And they're feeling if they move, they're going to be paying so much more for their house. So it doesn't make sense and they're staying put. So that is that lock-in effect that we're talking about that's holding our existing inventory pretty tight. The other sources of inventory are going to be new construction, which is usually less than 20% of the market, and in the San Jose area, even less than that. Single-family homes are really short in supply for new construction lately. We're seeing more multi-family units coming to market, but in San Jose, we are pretty landlocked. If you think about Las Vegas, it just keeps expanding. San Jose, we can't do that. We've got valleys, we've got the bay, we've got mountain ranges and stuff that are locking how much land is actually available. So we're pretty tight in that area as well. And then the third source is going to be distressed inventory, or foreclosures as a lot of people will refer to them. And that inventory is also in short supply for multiple reasons. But first off, the market has appreciated in value quite a bit lately. So even if somebody is in a distressed situation, they typically can go ahead and sell that property pretty quickly and get out of that situation in most cases. The other solution is that during COVID, a lot of banks came up with different processes to help homeowners in distress, and that is really alleviating any pressure of a rush of foreclosures that might or might not happen. But definitely that source of inventory is very low and keeping our inventory supply low. Then the third is going to be affordability. Now, we are in the worst affordability in decades. Yes, I know. Between interest rates and home prices, affordability is very difficult, especially in the San Jose area. And then the last is going to be availability of credit. And we don't talk about this one very much because usually it's not been an issue. But as interest rates have gotten tighter and the federal government is tightening rules with banks because of Silicon Valley Bank and some other things that have been happening, that is what kept our interest rates a little bit higher and might continue to do so, but also might tighten the availability of the mortgage supply market, which could be an additional pillar or effect that we might see coming in more to our day-to-day market. So now let's talk about the Santa Clara County market specifics. So we are experiencing a battle of those two main pillars, supply and demand, for sure. Our sales numbers are matching our supply numbers, meaning we have about a 1 month inventory and that's it. I went back and looked at some history just for you to give an idea of how today's market compares to, say, the pandemic years. And you'll notice that in July 2023, 554 sales, which is pretty low looking down through previous years, but our inventory is 555. So 100% of homes that were available were selling, right? So that's a 1 month supply or 100% here. And if we look back down, that number 555 is extremely low for inventory for July. But if you're looking at the percentages, last year in 2022, it's when interest rates started to go up. We had a different kind of supply and demand imbalance. We had a lot of supply and a lot less sales. And that's when prices had to adjust to compensate for that, right? July 2021, we were selling them so fast. We had less than a month of inventory. 125% of homes that were available were selling. That's just because they were moving so fast. And in 2020, it was 113%. So we're not as crazy as the pandemic as far as how fast we're moving. And we're definitely not at the same volume. We're about half the volume that was happening and the number of sales, but the rhythm is quite similar. Definitely a better rhythm than a year ago when those interest rates started to go up. And I think that's because buyers are starting to get used to these higher interest rates and figuring out how to make it work and realizing that it's not going to change anytime soon, right? So talking about those interest rates, they have just been on a slow and steady increase overall. We're in the high sixes for jumbo rates. Conforming rates are in the 7% range, which is affecting the condo market some because those are a lower price point and a different type of loan. But like I said, buyers are kind of getting used to this flow and this rhythm and figuring out how to make it work. Unemployment continues to remain low, below 5%, but it has increased the last couple of months. We're up to 3.6% in Santa Clara County. Now, stay tuned. We're going to get into San Jose single family market stats as well as a market forecast. Good info there. So here's the chart on just San Jose single families for July 2023 or updated through July 2023. You will note that the average and median prices, well, specifically the average price has dropped. The median is showing a change in curve for this area. Now, if you went back to Santa Clara County, that chart, it actually has been dropping on both aspects. But San Jose is a little bit different market, and about 50% of the sales in all of Santa Clara County happen in the city of San Jose. And it's a little bit more affordable section as well. So it's a great area to get a feel for the general rhythm of the market. Now look at this. Here's the sales numbers. We're the last several months higher than our inventory. We're getting back in line, but not as much. And we saw 100% in the Santa Clara County or 1 month inventory. In San Jose, we're still lower than that actually. Selling more homes than are available on the market, meaning they're just not staying on the shelves and they're turning really fast. Our supply is extremely low. If you look at this yellow dotted line across, especially for the summer, right? We're looking at winter type levels that we've seen in the last several years or in all of history. So very low supply that we just have not seen in this area. And the sales are definitely lower than typical. Part of that is the supply. Part of that is the affordability that we talked about and mentioned. And did we hit our peak price? Typically, we're going to see that in May, June, sometimes July. But as you can see here, July, the average prices actually started to drop. So I think we're getting to that price peak that we typically see seasonally. Now, as you can see, not every year peaks in the middle of the year here. This had like a little early peak and then a late peak, but typically this was a mid-year peak and then it took off again in the fall. So a little bit of different rhythm, but typically we see some sort of price peak in the summer. And I think we're at that point. The question is what will happen in the fall? So let's look at the actual stats. There's a couple really interesting things to point out. Number one, the average price is up 6% year over year. We are starting to see where those interest rates increased in 2022 and affected prices. Now we're seeing that we've gained 6% over that. Yes, pretty amazing. So let's going back to that chart. We had this kind of big boost here before interest rates went up and when inventory was very low, where we saw prices shoot up. But then interest rates went up and prices had to adjust and go down because we had more inventory sitting there than sales that were happening, right? But now we're up year over year. Still seeing quite a bit of aggressive overbidding, 7.2% on average, which is up, right? That's pretty amazing. And again, due to low inventory, buyers are realizing who want to buy, they want to get in, and they got to pay to get in to get that opportunity. And we're seeing this price trend of really healthy and year over year appreciation, even though interest rates are a lot higher. It's just because our supply is so low and the demand remains there. So stay tuned. We'll get into a snapshot overview grid to give you a feel of kind of where I'm seeing the market. So like I mentioned, have prices peaked for the year? Probably. We're very close to that. We're seeing prices similar to summer 2022, though if you go July to July, we're actually up that 6%, right? But the interesting thing is it's costing buyers more today to buy a home than a year ago, even though the prices are higher. Ew, that's interesting, right? But if you remember last summer, interest rates were around 5.5%, which felt horrible because in the spring of 2022, we were in the 3% range. So that was a huge change, but looking to where we are today, close to 7% range, was still quite a bit of savings in that interest rate percentage, right? It's amazing those goggles 2020 looking backwards give you 2020 vision, right? So sales price to list price ratio is still going up. That's positive. The price trend is settling. I don't think that's a bad thing. It's pretty seasonal. So I put a question mark there. Days of inventory is still very low at 24 days. That is a definite positive, healthy market sign. Unemployment's at 3.6%, which is still in a normal, healthy range. And interest rates are not great. That's one of the things that's causing the pause or the slower market. But there are buyers still out there buying. So looking at our forecast, I've been saying this for months on end that if the supply continues to remain low, the demand is likely to push prices up. Check. That has definitely been happening in 2023. But prices may retreat in the summer unless the interest rates drop, which interest rates are not dropping, and we're starting to see that summer prices might start to retreat. And we don't think interest rates are going to be improving this summer anymore. It's looking like it's going to be a little bit longer time frame because of what's going on with the banks and things being redone at the federal government level potentially, right? And we also stated if unemployment stays below 5%, then the market demand is not going to be affected too much. And check, we are definitely seeing that as well. So end of the year, I expect we're going to be slightly up from January 2023. Right now, we're up 6% year over year, and more from January, but I expect those prices to settle a little bit to a more seasonal, typical year, like maybe we see. That's not a good example because it was actually lower, but many years we see a slight appreciation, then a little settle, like in here, these last several years. So I expect that's something that we're going to see coming forward unless, again, interest rates improve quite a bit. Now let's talk quickly about the condo market. And you know what? If you like this data, you find it valuable, you want to have an in-depth discussion with me about the market and your plans, I would love to sit down and have a buyer consultation or a seller consultation with you. Definitely check out the links below to learn more about those. Okay, so the county-wide market for condos is different, again, because of price point and interest rates. Also, the inventory is low, but not as seasonally low as what we're seeing for single family homes. So as you see here, you draw across, there's many times where we've been at this kind of inventory level, not really many summers, right? But many times that we've been at this level, unlike single family homes where we're almost at record level lows for inventory. And sales are decent, but a much closer match to the inventory. So we're, I think about a little over a month inventory. Yeah, so 33 days of inventory. Where in single family homes for San Jose, we were 24 days of inventory, if you remember. So moving a little bit faster in the single family home market. And the prices for condos and townhomes are still down year over year. We haven't seen that recovery, but our inventory is way down. It's half, 55% lower than where we were last year, which is what's keeping that condo townhome market afloat a little bit. And just the closed sales we've noticed are really down again. I think the interest rates affording a 7% interest rate as a first-time home buyer looking to buy a $1 million townhome condo with an HOA fee just really adds up, again, making that affordability the worst we've seen in decades. So if you'd like to learn more, again, about the market, have a discussion on the micro area you're talking about or which pocket is the best for you, please do reach out for my home buyer and seller consultation, whichever might be most appropriate for you. I've got a great buyer guide tips on my website as well. Thank you so much for joining me. I get a lot of requests asking how to keep up to date on our content and local events. So I recommend you sign up for our education-focused newsletter at homeownerexperience.com/newsletter. Once you do, you will get educational videos, including professional insight on the San Jose housing market, interviews with experts to educate homeowners, and get invited to our local events. Our mission is to revolutionize the real estate experience for you through a focus on education, transparency, and an unwavering commitment to your success. And the newsletter is a source to tie all the content together for you. Sign up, and if you don't like it, no worries. Unsubscribe anytime.